Thank you once more. In this video, we continue now. In this one, we are going straight into making a trading system. Now, here we are more specific. We are not as general as we were when we talked about how trading systems are developed. Now we are making one using the same steps, using the same procedure, using the same process. Now we are making a trading system. The trading system that we're pushing is the one that really helps traders to trade intraday setups. So intraday, remember, from M30 to H4 to H4 is intraday, meaning that you are likely to be trading just for a day. Most likely, you could exit your trades within a day. It could take 2 days sometimes, but generally it takes between a day up to 3 days. So the system meaning that trade anything from M30, I'm okay. You can even go straight to M30. We'll do our examples on an M30, but I'm okay that you can test or practice this on M30 time frame, H1 time frame, and H4 time frames. So we are going to be choosing, so in this instance, we are going to be choosing moving average 12 and moving average 26. They are both exponential. One will have another color and they will have different colors. Okay, then we're going to be using the MACD as the confirmer or the auditor. So the moving averages will get us trends or will identify trends for us. Once we've got them, then we're going to be using the MACD to confirm or not confirm the trend. Once that's done, then we're going to be doing this exercise of checking the risk that we can expose to that trade. We've already spoken about that we're going to be using up to 1%. Then I'm going to be dealing today, I think in this video, with what does a lot size mean and how would you know the lot size or the volume of a trade, the quantity, the contract amount, lot size. So that's going to be important. Let's get started. So we're going to be going to our platform. In our platform, in this instance, I choose USD ZAR. I could choose any pair. I could really choose any pair. I've got USD ZAR and I go to M30 because we said the minimum I'm going to use is M30. I could use US dollar, Australian dollar, US dollar. I can also choose minute 30 and then just check how it goes there. So I can really choose any, I could choose euro dollar, go to M30, I could choose. So let's stick with any. In fact, let me go to the Australian dollar because we have dealt with the US dollar, South African rates before. So let's go to Australian dollar and the dollar of America, the greenback. So we start first by M30. So that's what we have done there. It's M30. You choose M30. All right. There's our M30. There's our M30 chosen. That's the time frame we've chosen it. It's confirmed also here, and the pair is also confirmed. There it is. Okay. Now what do? We said we insert step number 2. We said we insert moving averages. Moving averages, one must be 12, must be exponential, and they must, a method is exponential, and it must be applied to close. And then from there, we are going to be choosing the color. The color we chose for this one is going to be red. So there you go. There's our, remember the thickness, I spoke about it. Now there is our moving average, 12. You go again, you insert another moving average. You insert another moving average, and this time it's going to be moving average 26 exponential. Apply to close, then you choose a different color. Just choose a bright color. I've chosen lime. There we go. Please note, if you want to change the colors of your charts, you don't like white colors again, you can come to right click anywhere on your chart, you go to properties, then you can choose the candles that you like. If I want the candles, this goes down to be red, I just choose red because I want the ones that goes down to be red, the one that goes up, lime, down, red, bull, lime, and then from the bear, because it's bearish, then it's red. Then you are done, then you just say okay. Now I've got red candles and lime or green candles. So red for down and green for up. I'll leave it like that for those who like it. And then from there, if you want to save, we'll save the template later. Now let's go to step number 2 of our trading system. We said it's going to be the MACD, as you write it. The MACD is going to be our step number 3. It's going to be the confirmer. We don't change anything on the parameters, and then we just say okay, and that's how our MACD looks like. I'm just gonna to change so that we can see the histograms. I have made my histograms deliberately thicker, but I want to make them smaller for sake. There they are smaller. Let me even make them whiter, because here they're dim gray, but I can also make them much more brighter like this. How is that? So there it goes. So that's our MACD. And then lastly, we are going to be having the stochastics as a timer. You don't change the parameters or the settings, leave it as it is, insert it. So this is how your trading system's components will look like. You are using 2 moving averages, one both exponential, one is 26, another one is 12, where 12 is the fastest, it's called the fast moving average, and 26 is called the slow moving average. The MACD is going to be the one that confirms or that keeps these guys in check. So every work that it does must be checked against how the MACD is doing. If the MACD doesn't agree with whatever that they've identified for you, then we go back to them. We'll go back to step 2. You do not make step 3, step 2. You do not make step 2, step 3. Then from the once that's found, then we can go to the stochastics. It really must work in that order. Please, it must work in that order. This is our step 2. This is our step 3. And this is our entry. In this case, it's our step 5 on the trading system. All right. So step number 3 cannot be 2. All right. That's how it works. So let's start. How does this work? Okay. Let's go back and read what the procedure or what the rules of the trading system says. So the rule of the trading system say, that's a crossover. The rule of the trading system says buy, there it is, exit, buy, long trade when, stop loss. I think this one is the exit rules. The trading rules. Oh, there's the buy. We buy when 12 has crossed 26 up, or it's above 26, because it's going to be an uptrend. The MACD histograms must also be, and the trigger line must be above 0, above the MACD line. That will be uptrend confirmed. Then the stochastics must be over. So that's the rule. This is the buying rules. For those who wants to go long, all of this must be ticked. It must be 1. You must have a tick here. This is 1, must be correct. For 2 must be correct. And 3, you've got 3 checks to do before you can enter this deal. Okay, so this is the entry rules. And that's the exit rule. The exit rule, it's here. The rules for exit, rules to get out. You do not get out until you have followed these rules. Okay. Let's deal with it again. Okay, so, and then let's read it again. And then from there, you enter a sell or a short trade when the opposite of the long trade happens. The 12 moving average must have crossed or must be below, crossed down the 26 to the downside, below the 26. The histograms must also be below the MACD line. The stochastics must be overbought, tracing, and you only exit either at resistance points or when the stochastics, you only exit, you exit. Stop loss is going to be at your resistance point, first resistance point, and the take profit is going to be at your support, first support point. Please check that the ratio to reward, it must be equal or more than 1:1, something that I mentioned before. Right, so let's get to the system then, just to demonstrate now. We are now on odd US dollar. We have got our, we remember that we had, opened our chart is on Australian dollar. Yes, our chart is on Australian dollar and the Aussie and the US dollar on M30. So now we see step number 1, we see that the 12, just put a cursor there, the moving average 12 is below the moving average 26. What trend does it make? So this is called a downtrend. Okay, you see it as a downtrend. The downtrend is confirmed if the histograms and the trigger line is below 0, and there is below 0. And when I see this, I see that these guys are below 0. There is the 0 line. I can zoom out again. There is below 0. That's a downtrend. And now here we say downtrend confirmed. So there we go. So fully confirmed. Downtrend is now confirmed. So anybody on this time frame using this system in this pair, if they are not in a downtrend, according to this system, they've gotten it wrong. Okay, so we are going to be checking if the stochastics now before, this is the entry. The entries is going to be, we're going to be putting there and say, wait for stochastics to come here. Wait for stock to come here. No, sorry, it's not here. It must be somewhere there. All right, there you go. That's exactly. So wait for stock. Wait for stock. Wait for stock to come here. Right, and I think that's what happened. Let's do it again. So let's do it again. So in a downtrend confirmed, and you can see that what these guys were doing, why did the market sell so heavily? It was because when the stochastics was overbought, when the stochastics came to these levels here, they then sold, and it was just about when the stochastics came, when the price was somewhere there. So when the price came around 0.68, this was a sell entry, so they went to sell there. They sold here. Why? They sold here. If they sold here, there, it was a downtrend confirmed in the stochastics. Why? So they sold here. I'm going to write another one. They sold at this time. Sold here. Okay. Everything was fine. So that's how exactly what happened. But let's just check whether, let's just check if everything was spot on. Okay, they sold when they sold when it came there. So let's check now whether the risk was going to be worth it. Okay. Right. Let me show you how the risk is going to be working. At the moment, it looks like the entry was found, but could we have entered it? Could we have entered it? We would have not entered it. So because the market was here when the time was right to sell, we are now going to be checking where was the first resistance because it's selling. The resistance is a point at which the sellers rejected buyers, and it looks like it was there. So this was the point here. You see the sellers rejected the buyers here at this point there. Make it much more bigger and we give it another color, and you can see what I'm talking about. It was at this point that the sellers rejected the buyers. So the market was moving pretty much something like, the market was moving something like this. It was moving from there. That's the sellers. Here are the buyers, and the sellers rejected them. So you are now finding this point as resistance, but your sell entry is found somewhere there. The entry of our sell, it's located somewhere here according to the system. Right, so when you sell there is going to be a stop loss. Then we check the distance, simply take the crosshair, click from the beginning of your entry, we drag up to calculate the number of pips. The number in the middle is the number of pips. You take if the decimals are 3, it is because it is, you can see that your broker is quoting you in 5 decimals. Can you see on the other side? 5 decimals. There it is, 5 decimals. 5 decimals means pipettes. So for you to get pips, you must always divide the number you see in the middle. You must divide it by 10. So let's go again. Divide the number. The number in the middle is the one that measures the difference in between those 2 zones, and you divide it by 2. So 300 by 10. So 322 pipettes divided by 10 is 32 pips. So when the market was there, this is 32 pips. 32 pips. So 32 pips is the stop loss. Your entry was here, and the risk was 32 pips, or the stop loss was at 32 pips. And the stop loss is at 32 pips. So the stop loss is at 32 pips. So meaning that our reward must not be less than 32 pips. When we said here, our reward must not be less than 32 pips. How do you make sure? Usually, again, you need to do the same thing. You're gonna be checking 32 pips. You cannot take this trade if you are not gonna be taking 32 pips. Usually we'll do something like this. Again, take the mouse, put it from your entry, and then go again 322, because it's 32 pips, 32 pips. So 32 pips is somewhere there, 32, there is 32, there is 32. 32 is somewhere on 0.67743. 67433, the number on the extreme right is the price. The number in the middle is the pipettes. So we're going to be stopping at 0.67743. 0.67743. Take this line, 67743. So I'll take it up below 67743, somewhere there. Just estimating, somewhere there. So when if the TP is there, then they're having a good entry. So in this case, the distance between entry and stop loss is at least equal to the distance between entry and take profit. Then you can enter that trade, take profit, TP. Okay, so that's how the system works. So it just works like this. In this instance, you put it like this. Last part is the issue of the reward, or the lot, or rather the lot size. How do you determine the lot size? Remember, it's 32 pips each. How then do you determine the lot size? You determine the lot size by the amount of the capital that you have. Okay, the capital that you have will determine your lot size. Let's check. This demo account has got how much? It has got, So this demo account is now left with 1,250. So we can use the equity amount. Let's say 1,000, right? So because this account has got 1,000, right? $1,000, we are now gonna be estimating using I would like us now to go look how to determine the lot size. Okay, that's the last part. Let's go back to this to make sense of this. Okay, so the lot sizes are calculated using this. So what you need to note, please note this. In currency trading, we use, the benchmark is what we call a standard lot, the mini lot, and the micro lot. So I will explain this more and more in the classes, but this is going to be something that matters a lot more most. So those who click 1.00 on their platforms or the lot size, it means that they have got contract worth of 100,000 units of currency. So in this case, if the entry is 1.00, you have just bought or sold 100,000 worth of that base currency. And if you are using 0.10, that's 10,000 units of that currency, and 0.01 is 1,000 units of that currency. So when you use 0.02 is 2,000, 0.03 is 3,000, 0.04, 4,000, just like that. 0.15, 15,000, just like that. So why is it important? It is important because I'm just going to add something there. It is important because when you trade, assuming that we are trading the major currency, when the peak value, when you trade the this lot size, the peak value or there is going to be 10. Here you make $10 per pip. When one pip moves and you have got, and you're trading with one, you make $10 per pip. Here we make $1 per pip. One pip movement when you are trading with mini lot, it's $1 per pip. And when you trade with the smallest, you are gonna be making 10 cents per pip. You see that the person who trades standard lot size is going to be making more money. The more contract, bigger the contract, the more the money. The smaller the contract, the lesser the money to lose or to gain. Now, from that example that we've had of US dollar, the stop loss and the take profit, remember, was at 32 pips. Okay. So meaning therefore that if the market could move from there to take profit also, then we are going to be multiplying. Then you're going to be multiplying 10 if you're trading with one. So if you're trading with 1.00, it means therefore that you are going to be losing $10 times 30. How much is that? That's 300. You're going to be making or losing $320 or making $320. And the guy who is trading at 0.10 is going to be making $32 or losing $32. And the one trading 0.001 is going to be making 32 cents. No, $3.20. Yes, $3.20. $3.20. So that's how, I think so, yes. I think that's how it goes. So when we go back to that, the one with the biggest lot size will lose more money. So in this case, $320, trading one in $1,000 account, what does it give you? Remember, the capital in this instance is $1,000. I've got $1,000 there. If you've got $1,000, then you lose 320. What's going to happen to you? It means, therefore, that you have lost way over 30% of your, you have lost 30% of your capital in one trade. And that is exactly what we don't recommend, that don't lose so much money in one trade. Okay, so it does not make sense for you to be losing so much money in one trade. So, but when you lose $32 is just about 3%. Still high, but it's better than the 32%. That's why I was recommending generally that we go to smaller lot sizes for smaller account, for smaller capital. So the ones who traded 0.01 would just be getting $3.20 or losing $3.20 on the same movement. So in this instance, the market would have moved the same amount of pips for everyone, remember, because odd US dollar would have moved the same for everyone, but what we make and what we lose would be different. So in this case, what we make and what we lose is different. So the guy who sold here using 1.00 would lose $320. The guy who sold would make or lose $320 using 1.00. So you should be careful of that, that in order to preserve or to protect your account, you should then be trading with the correct lot size. All right. Perhaps the correct lot size for that trade for $1,000 could have been half of the mini lot, which is 0.05. If you're using 0.05, you could have made either lose $15 or gain $15. Okay, which is about 1.5%. So that's exactly what we're talking about. So this is how it works, and I hope that you see that, and then next time we will cover it more. Keep practicing, keep going through the video until you get it right. If not, I will see you soon. Thank you. Bye.